Wave 2, in a declining wave 2, pessimism rises. It is actually fashionable to be pessimistic. The larger trend is still considered down. Remember what Bob talked about when he described the wave 2 pullback from in 1937 through roughly 1942. Usually, wave 2s are sharp, but a long, drawn-out correction helps to develop that same kind of apathetic disgust with the market and everything associated with the market just as well. In other words, it doesn't matter how they wear you down, price or time, as long as they wear you down. Wave 2s also are typified by low volume at the end. Let's first take a look. This is page 269. This is the September low in 1985. At this point in the market, we'd been rallying for roughly 3/4 of a year off the low that occurred in early 1985 and off the primary wave 2 low, which occurred back in August of 1984. So the market had been up for quite some time now. That's the above chart. This middle chart is a 10-day moving average of a dollar-weighted call-put ratio. Now, what a call-put ratio measures, what option ratios measure in general, is the aggressiveness of those people who are playing with highly speculative vehicles. In this case, if the public at large is buying a tremendous amount of calls, reflecting a tremendous amount of bullish sentiment, you can expect that the market is not going to go substantially higher. Vice versa, if the public at large is buying a tremendous amount of puts, which would make this ratio come down here, the call-put ratio, reflecting a tremendous amount of bearish sentiment, you would expect that the market doesn't have that much more room on the downside. And that's what we see here. Now let me line up a few points for you. Intermediate wave 2 that occurred here on the chart, on the price of the Dow, is reflected with this point here. Minor wave 2 is reflected there. This minuet wave C is reflected at that low. And finally, minute wave 2 is over here. Now let's take a look at what has taken place here. At this low, for intermediate wave 2, which occurred at Dow 1180, the market was approximately 100 points higher than it was in the summer of 1984 when primary wave 2 bottomed at Dow 1084. And the call-put ratio was at the lowest level that it had been since that time. Now let's take a look at what happens. The market rallies and has a little retracement, comes back to Dow 1240, 60 Dow points higher than it was at intermediate wave 2, and yet the call-put ratio on a dollar-weighted basis is the lowest that it has been during this entire time. Watch how this continues, because this is typical personality within a wave 2, especially a wave 2 correcting a bull market pattern where the public disgust for the market continues to grow. At minuet wave C, right here, look where the call-put ratio is, almost off the chart. This set a record for the time that we had been keeping the chart, which at this point was over a couple of years, and yet the Dow is at 1300, almost 120 points above this point here. The market has trended higher. It just hasn't gone there as quickly as the public would like it to, and therefore they're disgusted with it. Now finally, that correction ended in September of 1985 at Dow 1290, a whopping 10 points lower than Dow 1300 back here, but it took a little bit longer and the public was pretty wrung out by this time, and the call-put ratio was in the basement on this chart. That, coupled with the bullish consensus number, as reported at the time by Peter Hacksteady, 23% bulls, presented a compelling sentiment picture for wanting to own stocks if all the other ingredients were in place. And that type of sentiment is typical at a turn, and it's very, very typical. That type of hatred of the market is very, very typical at the end of a wave 2. Now additionally, this lower chart also appeared in the letter. This is a 10-day moving average of the CBOE put-call ratio on the bottom. The upper line is the Dow. Let's take a look at some of these numbers. Here's the August 82 bottom. This is at the end of a 16-year bear market, and the 10-day put-call ratio was peaked at 84. Now, that's a pretty impressive number. And the Dow, by the way, was at 777. Now, a couple years later, we made a bottom in August of 84, and the Dow bottomed at 1084, a little over 300 points higher. And yet the put-call ratio coming into this low on a 10-day basis was as high as 77%, which reflected a tremendous amount of animosity toward the market. And finally, at the low that we've seen here in September of 1985, the Dow is at 1290, 500 points off the August 82 low, and the 10-day CBOE went to a new high, reflecting even more pessimism. That's classic Wave 2 action. That's Wave 2 pessimism. This is Wave 2 optimism, because it works both ways. Let's just focus, for example, we looked at put-call ratios. This top chart is also a chart of put-call ratios, but let's take a look at these two figures here. This lower chart is the Dow Jones Industrial Average on a daily basis. Some of you may recognize it. This was 2733. This is Wave 1. This is Wave 2. This is the picture we looked at earlier on the Dow, when we looked at the Dow weekly. And what took place after this was that, down to Wave 3 in October. But the point that I want to make here is in regard to this chart, which is a 10-day moving average of weighted futures premiums that we keep. Now this is the zero line here. The last time that futures premiums on a weighted basis, daily, had reached these levels was several years earlier in a B wave in 1984. We're going to take a look at that in a couple of minutes. The market had not made a new high. This was C of an irregular, right here at this point, and futures premiums were the highest that they had been in 3 years. That type of optimism is what you would expect to see in a Wave 2, which is correcting a larger downtrend that is taking place. And, of course, this was Dow 2645, or roughly.